manufacturing, industrial, service businesses, and we're going to touch up on real estate deals as well. Old school is back in favor. Why profitable, boring businesses are exciting for many investors. So we're going to go down the line. If you can just introduce yourself quickly, where you're from, what brings you here, and a little bit on your area of focus.
Thank you very much. Hello, everyone. And I am the Managing Director for Free Will Capital and partner at Family Office Alpha. And I'm representing family offices from Asia. And my area of focus is background in immigration investment and real estate debt financing, especially bridge financing. And my area of focus right now is on allocation of real estate development projects, including multifamily, mixed use, and townhouse development, and also healthcare technology.
Good afternoon, everyone. And I am director of Colton Alexander, which is an asset management and investment bank affiliate. Our focus is sustainable companies and infrastructure projects. And we do project development as well as financing, and we get involved in all things green. So, for example, we have under contract hydrogen producers, waste-to-energy plants. We have conversations with green steel, certainly green construction and green roads, and the list goes on. And the idea is to build out ecosystems both to create business and to finance those businesses, all hard assets, and usually Series A and Series B, and larger for the infrastructure project. Thank you.
Awesome. Can you give some examples? I mean, you said like green roads, right? Green infrastructure. What does that look like? What have you seen that kind of meets that criteria?
Well, with regards to green roads, there are specific companies that have developed technologies that are able to build the kinds of roads that last way longer than we see on the streets of Los Angeles, for example, which every 6 months it looks like you have potholes. And they are at least cost effective and many times much less expensive than the current technologies. When you get into the other projects, for example, you get into green construction, the question is, are you substituting things for steel, such as timber, or are you perhaps using things even like in a conversation yesterday with building blocks made out of hemp? And that is actually something which is being certified both for resistance to fire as well as resistance to earthquakes, and is getting quite a bit of traction as the case might be. So all of the different materials and that we look at are connected to each other, in essence, to build a sustainable society.
Got it. And really curious, I'm always really curious on the topic because you said Series A, Series B, and then when we talk a lot about sustainability, it's almost like futuristic and things that may not be very mainstream right now. I mean, are there long time horizons for these type of investments?
I would say that these investments we would describe as evergreen, which means it's going to be a longer time horizon than, for example, a venture capitalist may deal in, but it isn't forever. And the other part of it is, particularly when the projects are large, for example, if you do a green steel mill, it's $1 billion project. Now, you do have a lot of government support, particularly in the United States. So therefore, you might be in a situation where half the project is being financed by the government and the other half by private interests. And it takes time to build these out as well. I spoke to our hydrogen client and they said, well, it's 18 months to build out one of these hydrogen plants. So you're in it for the duration, but of course, we are talking here about market rates of return. We're not talking about concessionary rates of return. So the intent here is these are commercially viable projects which have government as well as private support and are worth looking at. And we think they're de-risked because they are hard assets. So I see this as a big advantage.
Awesome. Thank you.
What's up, everybody? So Rainbow was actually founded by Gould Investors LP. The Gould family has been investing in real estate for the last 64 years. Currently have about $2 billion under management, including 2 public REITs. There's BRT Apartments, which originally was actually just a lending REIT. And, about in 2008 or 2009, they moved that into multifamily. and One Liberty Properties, which similar was originally focused on retail, and then in about 2009 they moved to focusing strictly on industrial properties. That kind of goes in line with the way the family has been investing for the last 6 decades, sort of always trying to find new niches where they can kind of find an opportunity that other people don't see. That's kind of what's led into Rainbow, which is where I work. So Rainbow focuses on U.S. real estate in the cannabis industry. This opportunity we find very interesting because, it's not federally legal yet, although it's legal in 41 states, both medically and 24 and recreationally. They can't get funding from FDIC-insured banks. So, you can't just go to a bank and get a mortgage. There's definitely a lack of capital in the space. So we find that, we're able to get the same risk, a normal industrial building or a retail building. We're underwriting it to alternative uses, so not cannabis. But we're able to get, 3 times the rent on these properties, for example. We're trying to find a way that, we found it a little bit difficult in, regular real estate plays in the last couple of years. Where in this, we definitely think that there's an edge that, we've been able to find.
Excellent. And I guess interesting because last year, I would say the reports say that capital infusion to cannabis related deals fell by 91%. So very interesting for you to say that.
Yeah, so that's mainly on the equity side. Mm-hmm. So what we do is really just a real estate play with cannabis tenants, right? So a lot of people that invested in equity in the space have definitely had a tough couple of years. But our fund has been, performing pretty well. We've never missed a distribution to our investors. We've done about 25 transactions over the last 5 years, about 135 million assets under management. We've just found that, again, we're underwriting to the same way that the family always has been. But a lot of people won't, work with these types of tenants because it is federally illegal. Mm-hmm. Although, again, everyone we work with has licenses and is fully legal in the states that they operate.
Got it. Excellent. Thank you so much.
Going to save you a lot of time here. Add some digits to the clock. We convert motels and hotels into apartment-style housing. And we're on our 5th project now. We're growing and things are looking really good. A lot of inventory out there, and that's what we do.
Awesome. And, I have questions, though. So where's this 5th project?
It is in Brownsville, Texas, not too far away from Elon Musk's SpaceX.
Excellent. Was that intentional?
We love the data down there. Occupancies are very high. They're above 90%. It's growing. There's LNG gas moving in. We have, obviously, SpaceX, and there's just a lot of industry happening right across the border and even there at the southern RGV Valley.
And how did you guys source this deal?
These deals come from brokers. They come from distressed sellers. We don't use banks to buy these properties. We seller finance them. It's really hard. Funny enough, it's really hard to sell underperforming motel or hotel. So we show up, and one of the deals that we recently did, we paid $60,000 down, 0% interest, 18-month balloon. On other deals, we'll offer a little bit of the upside equity to the seller. And these sellers are pretty adamant about getting out of the deal as fast as they possibly can. So it gives us opportunity to get the best terms.
Was this motel, was it more mom and pop, or maybe it was a Motel 8 or?
Yeah, so the very first one we bought was actually a G6 Hospitality. It's a Studio 6. So we'll do branded hotels. This one was a Magnuson, which is a brand, a lesser known brand. But yeah, the mom and pop hotels, motels, and branded both work.
And, okay, interesting. And how many, so that 60,000 down, this was on the last deal?
Yeah, on the 5th. And there's a different deal. One in McAllen, Texas, but yes.
60,000 down.
Yeah, 60.
How many doors?
It's only 29. It's a little bit smaller one.
Got it. Excellent. And then most of these apartment units will be studio apartments.
Yep, studio apartments, boutique, motel, hotel conversions to apartments. They're all studio and larger MSAs, preferably large MSAs or secondary markets.
Are you guys selling these properties after the conversion, or are you guys holding on and taking on the tenants and managing?
We're in and out really quick. We take them on, and we're typically exiting in 18 months or month 24. We have the option to refinance if the deal is just too good, but it's tough to beat a really low interest rate with the seller.
And who have usually been your buyers?
Buyers include multifamily acquirers, hospitality acquirers. On 2 of them in Arizona that we did, or that I did, we just refinanced and held them and replaced some other capital partners with some new capital. Typical buyers are going to be your motel or hoteliers or your multifamily guys. So kind of both.
Got it. And, you're like, oh, we can keep this short, but I got more questions for you.
Sorry. Yeah, you're asking.
Yeah, no, for sure. I mean, I hear so much about you guys, through Richard. So always curious, and it's not like I get to talk to you guys every day. But in terms of, so you're saying, because it goes motels to apartments, but you're telling me hoteliers are the ones buying it. So they're usually converting, sometimes they're converting these back to motels?
So typically the zoning could be the deciding factor. If we don't get the zoning, the multifamily zoning on the property, and if not, then there's a couple different exits. We can keep it as a hospitality asset and run it as a long-term, short-term, mid-term type rental. This wouldn't include lease agreements. This would be more of a long-term, mid-term stay using hotelier software, using hotelier management, so on and so forth.
Government contracts?
Yeah, we can create corporate contracts with corporate employees or traveling nurses, so on and so forth. But yeah, we have a couple different exit options with this really flexible asset class.
Got it. Interesting. Awesome. Thank you so much, Andrew. Great.
I founded Touchstone Group in 2002, and we raise institutional capital for venture capital managers, GPs, growth managers, GPs, control buyout GPs, ex-real estate. Everybody seems to almost have a real estate component. We don't do real estate, separate thing. We focus on funds between 150 million and $1.5 billion. We just signed up one which is several hours of Zoom earlier today up in the room. We're going to be raising $1.5 billion for a European secondaries fund. That's about it. These portfolios that these institutions have, we call on about 400 family offices, so I am here. The family offices we call on typically have 500 to 700 million of assets under management that are investable, and they hire staff. And once they hire the CFAs to be a chief investment officer and a couple of people, one to do liquids and then illiquids, then they become our targets because we're calling them the CFA like they're Allstate or Robert Wood Johnson or Getty Trust or Duncan family in Houston or something like that.
Fantastic. And can you speak to some of the allocations you guys have been kind of looking at?
Well, right now, the allocations that these portfolios are mature, so they have the exposures they bargained for. And if they don't like it, or they get a new CIO and have an excuse to do something else, they'll go to the secondaries market. And because the liquidity cycle has seized up for a lot of the private equity marketplace and venture marketplace, the secondary strategies also include now about 50-50 of GP-led secondaries, either with a single asset or a couple assets, typically trophy assets towards the end of the term of their partnership. They create an SPV, and they're able to get new investors to come in, like my client, and take out old investors into a new entity. The manager lowers their fees. This is very popular right now. This GP-led secondaries, LP secondaries continue to be strong. There's dry powder, but way more deals than there's people. More people want liquidity than have it.
Yeah.
So it lends itself to a very vibrant market. Within that mandate, there's also a direct co-investment fund and a climate fund, which is, by the way, not doing well. This is a European manager, Geneva-based, been investing in impact for 11 years, have a track record in it. Launched their first single focus, fund on climate, and of course, this is a strategy that we all, not all of us, but I think it's a terrific strategy, right? I mean, there's all sorts of really interesting companies.
What, the strategy on impact?
The returns,
like impact, you're saying?
Yeah, impact. But you know what? It's not selling. And it's not the ESG political nonsense here in the United States. It's just not selling. We helped raise $1.3 billion for Pantera Capital, the crypto VC manager. And it was the same story. People wanted information. They would have informational meetings, but they wouldn't make commitments. And the institutions did not commit to crypto in the last cycle. They may this time. We may or may not represent Pantera for the next fund, but it was a very similar pattern where people just weren't ready to make those commitments. So a secondary fund, was terrific. We're doing a Chilean permanent crop fund, avocados, citrus, stone fruit, and 500 million target. Don't know if that's going to work. It should. Sustainability focus. They did a fund one that's working out really well. It's a counter-seasonal strategy. Of course, it's they're finishing up, they're harvesting now. But it's really only the biggest of the big that really understand what's going on. Central Valley in California and the Central Valley in Chile are virtually identical in terms of their agricultural potential, except Chile still has a lot of water.
Got it.
Interesting strategy. The Nuvines and Hancocks of the world, TIA, they want to give the manager 150, 200 million and say, don't do it for anybody else. But you're going to do it at 35 basis points and a 5% carry. And we're asking 150 basis points and a 15% carry in a commingled fund. We shall see. We have a European that will probably anchor it at 50. I think we'll probably get to 350, 375. But
So for these Chilean, I mean, you guys are, I'm assuming, who gets that capital in Chile? Who gets that capital? I mean, is it a big?
No, this is North American and European capital for a Chilean manager. This manager does. The manager has a real estate, infrastructure, private credit platforms where they have products they're selling primarily to the Chilean institutions, but the Chilean institutions are prohibited by regulation from investing in foreign land. So they have to look outside of their market.
Got it.
So they've raised about $2.25 billion since 2017 when they were founded for these other strategies. And, they have to look outside their borders for money. And by the way, it's permanent crops in Chile, for those who know, and permanent crops, oh my gosh, if you're doing it right, this is just such a cash machine. And it just steady cash, inflation protection. It's absolutely non-correlated. People are going to continue to eat avocados, stone fruit, citrus. If you have a competitive advantage in terms of your production, counter-seasonal demand, Chile will export about $7.5 billion of fruit this year. So it's a well-developed infrastructure. It's, in California, with these crops, you might be able to get, on a greenfield kind of project, maybe 10 or 11% net IRR. We're shooting for 15 here. Big difference, and it's the labor is 80% cheaper, the land is 50% cheaper, water is available, precision ag applied to these orchards. So we'll see. It may not fly,
Awesome. Do we have any questions from the audience? Awesome. Gentleman in the back. Excellent.
Hi, Tim. To the question. So I have 4 VC funds, and at some point we need liquidity. So you're talking about raising a continuity fund or a secondary fund to buy assets from an existing fund that's maybe hitting year 12 or 15. What are typical management fee and carry or any terms? And how should we view conflicts of interest? Because I raise money from LPs. I want to deliver alpha. And then I'm going to buy from my own fund into a new secondary fund.
Yeah, great questions. And the right question is to ask. So first of all, these continuation funds are typically trophy assets. So they're not troubled deals. We've been shown GPs who come to us with troubled deals, and they say, we'd love to find money for this. The answer is no. So these are trophy assets. Typically, there are 2 types. One is multi-asset and single asset. Single asset has, lacks diversification, so there's a bit of a damper on the number of people who want to do that. Conflicts of interest, really important. So where are you carrying the asset?
Recommend you carry them.
It's highly negotiable, but lower than 2 in 20, maybe 1 in 10. you'll wrestle that down with the new money. The new money will call that tune, and you'll dance to it. And the new money is going to pay out the old money, so you've got all these embedded conflicts. You're absolutely right. One thing people do, they sometimes hire valuation experts to go in and take a look at the assets and come up with an independent valuation. Most of the time, it's just where are you carrying this, and what are you going to sell it for? Now, on average, the private equity industry exits at about 1.2 times the NAV carry. Not NAV, the value at which they're carrying it on their books. So there's they're trying to be conservative, but what's the real value of this asset? And that's just going to be determined in negotiation, and then the conflicts are going to be resolved again through that negotiation. Ultimately, the new money is going to decide what they think it's worth. And if it's a real trophy asset and the GP is convinced there's they can continue a high slope to the growth curve, these are very popular now. I mean, this is, on the big side of the market, they syndicate it. So the Lexington, Collar, those kind of guys will syndicate these amongst their friends. And then if you're an LP, of course, you have huge overlap in these big portfolios. But, 1 in 10, typical. The conflicts get resolved through negotiation, and it's the new money, as always, that calls the tune you will dance to.
Awesome. And I think we had another question in the back. We have someone, and gentlemen, is it for Timothy again? No? Okay, awesome. That's not nothing. Yeah, good amount of mic time, so I'm trying to share it over here. But if we can bring a mic to the front, please. Awesome. Great, and your name and where you're from, please, as well. Oh, Brian.
So I recently went to a class that talked about, hotel to apartment conversions. And it was a 2-day class, and it seemed like half the class was horror stories about projects getting stuck because of zoning issues, permitting issues, things like that. And how many of your projects have you had these issues, and how have you resolved them?
Great question. So there's a company out there called WaterWalk, and I believe it was founded by the late Jack DeBoer, and he also created Candlewood Suites. He was the brainchild behind Candlewood Suites. The company WaterWalk right now is managed by Island Hospitality, and they actually do both. They have it strictly commercial zone hospitality, so they're not going to fight the city, they're not going to beat up the city, get multifamily zoning, and they're going to do long-term and short-term. And for the assets that are not rezonable, where we see the upside is to keep it commercial, to keep it hospitality, we follow that same model. It's funny, tomorrow I'm actually meeting with one of the heads at Island Hospitality to discuss a partnership. So they manage 20 plus WaterWalks right now. And that's a flexible management style where you see this a lot in large MSAs, corporate housing, construction, even locals. It's Class A appearance. Look up WaterWalk, you'll see it. It's beautiful. And that's really where we would pivot in the event that the zoning does not work out.
Fantastic. Thank you. Do we have another question in the audience? Right here in the front.
Talking about green energy investments and specifically converting waste into energy. Can you expand on that as an opportunity?
Yes, we're right now dealing with 7 waste to energy projects, which basically take things such as wood chips, cashew shells, put them through a particular machine, which converts it to, on one hand, electricity, the other hand, biochar. And the return on investment is very desirable because we get into the world of carbon credits. And plus you have government involvement with financing for these particular projects. So it really de-risks it in an important way. And one of the fascinating things with carbon credits is that not all carbon credits are the same, not all markets are the same, and being able to to accomplish an outtake agreement which is going to secure the investment is something that we're working on right now. And it's going to be rinse and repeat for this series of investments, which interestingly enough, is in a very particular market. We're very focused on our markets geographically as well as defining them, that these projects get an extra sort of lift from the government. And so I think that that's part of our strategy to make them much more investor engaged.
All right. Then you know what we're going to do? Start catching up over here. I think our 10th panel of the day is ready. So if we can please give a big round of applause to panel 9, everybody.